So I'm John Scott. I'm in the Raleigh office, and what we're going to be discussing today is term life analysis in the living balance sheet. We're going to be showing clients that they've got a term insurance policy and they bought it for a specific reason, but that policy is going to go away and lapse right when they need it. So what's important here is to have powerful language and to make sure that they understand that they've consciously bought something that is going to go away. And so what we're going to use is the term life analysis calculator in living balance sheet, and right now I'm in the design center. And what's important to understand before I start my narrative with the client is the numbers in here. You may not be able to read it, but what we've got is a 10-year study period. By the way, this is a 54-year-old and 50-year-old husband and wife client. This is a real case. The client bought term life insurance. We've got a $500,000 death benefit. The annual premium's $900. The numbers don't so matter much there. They don't matter as much as what I'm about to share with you, which is the study period. We're going to start with a 10-year study period and 10 years to pay the premium. And the reason that is because we've got to be able to show what those 10 years look like, and then I'm going to go out to 40 years, which will take them out to age 94, and show them what that 40-year period looks like, and we'll see a big difference when we get to the charts. So 10-year study period, 10 years to pay the premium, and I would never show the client that. What I do is I make sure I've got the design center set up. One other thing to note is I do check off this box down here, which is show life expectancy. It's going to actually put the life expectancy curve and overlay it on top of the charts. Clients don't even notice it until I get into the narrative. But this is for use in the planning process for almost any client that's got term insurance. So that's the design center, and now I'm going to the chart. And here is where I would actually start with the client. Okay, so Carly and Don, what you see here is a bar chart. We've got from year 0, which is today, all the way through 10 years from now, and Don, your age of age 54, all the way up through the next 10 years, which brings you all the way out to age 64. And as you know, you've bought a term life insurance policy. It's a $500,000 death benefit, and the cost each and every year is $900. So the bar chart here that you see is that level $500,000 death benefit that each and every year, if something happens to you, would pay out to you, Carly. And so that being said, what we notice is this is just the next 10 years. Your policy has that nice level death benefit, and it does exactly what you think it does, protects your family for the next 10 years. Well, when you get to age 65, most of my clients, and I'm sure you would say this, most of my clients say, you know what, I'm now at retirement, I don't need life insurance anymore, and my kids are gone. You know, if something happens to me, most of my debts are paid off. I don't think we need life insurance. And so Carly and Don, what I'll share with you is I completely agree with you. You don't need life insurance. But what could you do if you had it and it were permanent and it went through to the rest of your life? How would that make your financial model look differently? What else could you do with other assets, in other words? But let's just analyze what you've currently got right now and take a look at it. One thing you probably haven't noticed is while your death benefit of $500,000 remains level for 10 years, you probably didn't notice there's a little tiny blue line down here, and what that is, as I hover over that little blue line, is that actually is the life expectancy curve that we just showed you a few slides ago. And you'll see by the time you get out here to age 63, the chances that this policy will ever pay you a benefit, Carly, is 2.29%. That means 97% of the time you've put money into something that you'll never get money back out. You'll never be paid a benefit. Yet we are taught by Money Magazine and Wall Street Journal and all the talking heads, we are told buy term, invest the difference is the best thing for us. But I don't know about you, Carly, but Carly, if I don't know if you're a betting person, but if you went to a a horse race, and it was a 2-horse race. One of them had a 97% chance of winning, the other one had a 2% chance. Carly, which horse would you bet on?
97%.
Absolutely, 97% every time. The problem is we consciously make a bet on that 2% horse. You're putting $900 a year into this policy, betting that you will hopefully get a benefit out of it, but I'll tell you what, I hope you never get a benefit out of this policy, because that means you've passed away in the next 10 years, which we would never want. One thing that we know from the life expectancy chart that I shared with you earlier, and also is proven by this one, is the strategies and the products that I'm going to share with you are meant to last in the long term. I'm not betting on this 2.29%. I'm betting on the 97% that says you're going to live longer than 10 years. In fact, I hope you live for the next 50 years, past age 100. So all the products and strategies that I'm going to present to you are going to last forever, rather than this 10-year term policy that's going to drop off the books. Well, let's take a look at the cost of that term policy and the actual financial impact. As we said, you're paying $900 a year for it. So this year, you pay $900. That's $900 out of your pocket that you could have spent elsewhere. You could have, gone out to a really nice dinner with all your friends. You could have invested it in CDs or put it in a money market, or you could have put it into a piece of real estate. You could have done something with it. So there's also a cost to this $900. It's not just $900 each and every year for 10 years, which adds up to $9,000. But you actually could have paid off debt or invested in real estate or put it in the stock market. And so there's what we call a lost opportunity cost, or a time value of money cost. It's the same thing, just different language. This first bar shows $9,000 of total cost over the next 10 years, but then there's an additional $2,800 that is interest you could have earned elsewhere or paid off some of your debts. The point is there's more cost than just the payment. Now what I want to do is I want to take a look at the impact of this decision, not just over the 10-year period, but over the long haul. If you live, again, going back to that 97% horse running that race, if you live further than 10 years, which I'm betting you will, we've got to make sure that this strategy works in the long term. So what I'm doing now, I'm back in the design center. This is breaking role play. I'm going back to the study period. And rather than a 10-year study period, I'm making it a 40-year study period. The client's 54, 40 years, that's going to take him out to age 94. Click Save, and I do this on the fly with the client. I don't explain what I'm doing. I'm just telling them, now let's take a look at the next 40 years. Remember that little tiny amount that came out of your pocket over the next 10 years? It was $9,000, plus that little $2,800 interest cost. Well, that looks really small for the next 10 years, okay? But when we take that out over the next 40 years, the interest cost becomes almost just short of $60,000. The point is what could you have done with that money rather than throwing it away to the insurance company and letting it go into their coffers so that they can invest it? If you'd kept that in your life, you could have $60,000 to show for it, plus the $9,000 of cost today that you paid out of pocket. But that's not the biggest part of the story. The biggest part of the story is the fact that you've now lost a $500,000 death benefit. Right now, Carly, that $500,000 is sitting with Prudential. It's got your family's name on it. It's a block of capital that has your family's name on it and says if something happens, you get protection for the rest of your life. You get $500,000. And consciously, we decided to just drop that off the books. One of the worst days of your financial life will be, Don, when you're 64 years old and you get a letter in the mail, you open it up and it's from Prudential and it tells you, I'm sorry, but if you want to keep this $500,000 death benefit, you owe us $25,000. And then the next year, when you're 66, you'll owe us $30,000, and then the year after it, $35,000. It goes up each and every year. Why is that? It's because the insurance company wants to get rid of the risk. Let me show that to you. Here's why. So we go back to the probability screen, and now that little blue line down here where we were earlier, where it showed at age 64, there's only a 2.29% chance that this policy will ever pay out a death benefit. Now you start to see that that curve rises over time. However, your death benefit, which was level at $500,000, has dropped off the books. Just as the likelihood that you'll need it starts to rise. Now I want to ask you a question, Carly, just based on this. Can't you just see the life insurance company laughing their way to the bank every single time you write a check?
Yes.
Seriously. Let's put on our life insurance company CEO hat. If you're the president and CEO of a life insurance company, and you know that the risk of you paying out a death benefit's not until out here, yet you got premiums on tens of thousands of people back here, how much wealth is the life insurance company creating for themselves? They're hardly paying out death benefits. Only 2.29% of them pay out. Yet down here later in life, when you really need the coverage, the risk has long been removed from the books of the life insurance company. Why is it, though, that we're told we should buy term and invest the difference? Why is it that we would consciously bet on the 2.29% horse rather than the 97% horse that's probably going to win? I'm going to show you through the planning process how to make this death benefit permanent, forever. We want to bet on the 97% horse, not the 2% horse. And I'm going to show you how to do it with no cost out of pocket today. Okay, so there's enough assets, there's enough cash flow already in your life that's inefficient. It's going to the government, it's going to financial institutions, it's going in places that's not really giving you the benefits that I know are important to you. All I'm going to do, Carly and Don, is show you how to recapture those costs, reallocate them, put them back into your life, and we're going to have a permanent death benefit all the way out. And consequently, it's not going to cost you anything today, and it's going to boost your retirement income probably by 50% or more. Are there any questions? All right, so term insurance, that's how it works, and we're going to go about showing you how to make this death benefit permanent, so when you really need it out here, it's there for you. And by the way, it's going to leverage other assets and take the pressure off of them.